Welcome back to The Explainer. So today, we are cracking open a brand new toolkit. We're calling it the 2026 Financial Survival Guide. And look, we're going to break down exactly how you can play both defense and offense with your money, especially in an economy that's, well, completely unpredictable right now. Let's get right into it.
Okay, so here's the absolute most important question for you right now. How do you actually protect your wealth when prices just suddenly spike? This isn't some theoretical exercise anymore. The stakes are incredibly personal. And honestly, the old playbooks, like just leaving cash sitting in a checking account or, I don't know, just hoping for the best, they simply don't cut it when the macroeconomic ground is literally shifting right beneath our feet.
And wow, that shift is perfectly captured by one number, 3.3%. That is the year-over-year jump in the Consumer Price Index as of March 2026. Guys, this isn't just a slow creep up. It's a sudden surge that completely shocked the financial markets, and it instantly changed the math for everyday savers and investors just like us. So to counter this, we need a clear roadmap. Today, we're going to cover 1. The 2026 inflation shock, 2. Shielding your cash with IBonds, 3. Beating prices with used EVs, 4. Real estate passive income, 5. High-yield dividend strategies, and finally, number 6. Holistic retirement portfolio planning.
All right, moving into Section 1, the 2026 inflation shock. Let's really understand the macro threat here. Let's trace exactly how global events end up hitting your own wallet. So picture this. Late February 2026, the Iran conflict kicks off, right? This directly disrupts oil shipments flowing through the Strait of Hormuz, which is just a massive, absolutely crucial artery for global crude oil. And the result? Well, by March, U.S. gas prices surged an unprecedented 21.2% in a single month. No way around it. That hurts. And now, as we sit here in May 2026, that economic fallout is forcing pretty much everyone to fundamentally rethink how they preserve their capital. Basically, the cost of living is way up, which means our defensive strategies, they have to be absolutely airtight.
Which brings us to Section 2, shielding cash with IBonds. Time for our first defensive strategy.
So our absolute baseline for defense is the Series I savings bond. Basically, it's a U.S. government savings bond that earns interest based on a really cool combo, a fixed rate plus a variable inflation rate. And, because it's backed by the U.S. government, your principal is completely secure. But the real magic, that happens in exactly how this interest is calculated.
The math here is just fascinating. The Treasury just announced a 4.26% composite rate for bonds issued through October 2026. But if you look closely at the breakdown, it's really interesting. You get a 3.34% variable rate that tracks inflation. Okay, standard enough. But the real star of the show here is that 0.90% fixed rate. See, when you buy an iBond right now, that 0.90% fixed rate locks in permanently for the entire 30-year life of the bond. That is the highest fixed rate offered since 2007. It essentially guarantees your money is going to grow above the rate of inflation. Just keep in mind, there is a hard limit here. You can only put in $10,000 per person per year.
All right, let's look at everyday life. Section 3, beating prices with used EVs. So, how do you directly counter that brutal 21.2% surge at the gas pump? Well, you change what you drive. Listen to this awesome real-world example from Reddit user rough_cancel7265. They said, "The math for me is around $2,500 saved in gas over the last year and a half. Think about that. $2.5 grand. That is a massive, immediate financial impact. By ditching the gas pump altogether, you are literally insulating your own monthly budget from global oil shocks."
But hey, we've got to be realistic and weigh the full picture here. The pros are obviously huge. You get massive gas savings when fuel is hovering around $4 a gallon. Plus, right now, the used EV market is incredibly cheap. Actually, scratch that. It's a steal. 44% of used EVs are currently priced under $25,000. But check out the major con, insurance. While legacy brands like, say, a Ford or a Chevy might be cheap to insure, insuring a premium brand like a Rivian might cost you more than your mortgage. Seriously. So please always get an insurance quote before you buy, just so those high premiums don't completely eat up your gas savings. You really got to do the math for your specific situation.
Let's shift gears from defense to offense. Section 4, real estate passive income.
Okay, so if you want real estate income but absolutely do not want to be a landlord, you generally have two main paths. First up, REITs, that stands for real estate investment trusts. Now these give you high liquidity because they trade exactly like stocks, and they usually yield around 4 to 6%.
But because they trade on the stock market, they suffer from really high volatility whenever the broader market panics. Contrast that with fractional property investing using platforms like HouseMartin. Here you're investing in specific, tangible properties, like government-backed supported living facilities. The targeted yields here are quite a bit higher, typically 7 to 8% or more. And the volatility is super low because, well, it's tied to actual physical bricks and mortar. The main trade-off, lower liquidity. Basically, you are trading fast access to your cash for a higher, much more stable yield.
Next up, Section 5, High-Yield Dividend Strategies. Let's talk about generating some serious income.
So diving into the stock market, let's look at a classic offensive playbook, the dogs of the Dow. Honestly, the beauty of this strategy is just how simple it is. Step 1, compile a list of the 10 highest dividend-yielding stocks in the Dow Jones. Step 2, buy an exactly equal position in all 10 of them on January 1st. And Step 3, at the end of the year, you just reallocate those positions so you're maintaining the strategy with the new top 10 yielders. So why does this matter? Get this. From 1975 all the way to 1999, this incredibly simple mechanical strategy historically yielded a staggering 18% compounded annual return. It's just a fantastic, structured way to systematically capture really high payouts.
Bringing it all together now. Section 6, Holistic Retirement Portfolio Planning.
Okay, let's zoom out and bring all these individual tools together into a complete blueprint. A truly resilient portfolio, one meant for when you are actually drawing down your wealth, has to balance 3 totally different things at once. On one side, you need growth for tomorrow. That means allocating roughly 25% to large-cap stocks just to fight off long-term inflation. On the other side, you need income for today, so about 25% in high-yielding dividend stocks to pay your current everyday bills. And the massive foundation at the bottom holding it all up? Stability. Having 50% allocated across fixed income and tactical assets ensures the whole structure doesn't just collapse when the stock market inevitably has a bad year.
And look, getting this balance right is mathematically vital, all because of something called the 4% rule. Created by financial advisor William Bengen, this rule basically says that if you withdraw 4% of your initial portfolio value and then adjust that amount annually for inflation, your money should last 30 years or more. But think about the underlying math here for a second. An initial $1 million portfolio will actually need to generate an additional $900,000 in future growth just to fund those 30 years of withdrawals. That is a massive number, and it's exactly why you can't just hide your money under the mattress in cash. You absolutely need that specific mix of growth and income we just talked about. But on the flip side, you equally need stability. Over a 30-year retirement, it's just a fact. You are guaranteed to live through bear markets, deep recessions, geopolitical crises, and crazy inflation shocks. Kind of like stacked stones weathering a really harsh storm, having stability in your portfolio, stuff like those IBonds or that low-volatility real estate we discussed, it acts as ballast. It directly counteracts the wild swings of your stock holdings, and that is what allows you to survive financial storms without being forced to sell your stocks at a massive loss just to cover your monthly grocery bill.
So what does this all mean for you? We'll take a hard look at your own financial toolkit today. We've covered inflation defenses, the very real cost savings of EVs, steady real estate yields, and perfectly balanced asset allocation. I really want to leave you with this one thought. Is your portfolio built to last a lifetime? Like, do you actually have the defense you need to survive 2026 and the offense to thrive for the next 3 decades? Go ahead and review your tools, apply these strategies, and take absolute control of your financial future. Thank you so much for joining me on this explainer today. Keep learning, keep building that structure, and I'll catch you next time.